All right, I'm trying for the very first time to use this Panopto thing to create a video recording. And I thought I would use it to record something about what's going on in Europe's financial markets right now. So we'll do a current events issue. And we're going to do the current events issue around something I've been following very closely because it almost blew us all up, right? So the story I want to tell is about the European almost crisis, and it's an almost crisis that I'm going to tell in four parts. And the way we're going to do it is we're going to start with a pretty disastrous press conference that European Central Bank President Christine Lagarde gave on Thursday, the 12th of March. So we'll start there and look specifically at what Lagarde said that upset financial markets. Then we'll introduce what Lagarde should have said or meant to say. And in fairness, a lot of that material is stuff that she actually did say. It's just that the messaging got drowned out by the mistakes that she made in presenting the material initially. And so as a consequence, Lagarde had to come back and reiterate her position. Philip Lane, the chief economist, had to explain in precise detail how the policy was going to work. Fabio Panetta, the Italian member of the European Central Bank's executive board, had to come out and provide some reassurance as well. And then Isabel Schnabel, the German member of the ECB executive board, had to do her part. So there was a big messaging campaign. Of course, all that messaging by itself didn't really add up to much, so the ECB had to throw a significant chunk of change on the fire in order to calm the markets. And so what we'll do in the third part is look at how the markets responded. We'll bring a little bit of data in that I'll explain that will show you both the crisis that almost happened and when it went away, and then we'll finish by asking simple questions about why we might still want to be worried. Well, what did Lagarde say? Look, these press conferences follow a very standard script. There is an opening statement where the policy decision is announced. And in this case, the policy decision that was announced was a pretty generous policy decision. Market participants had been expecting the European Central Bank's Governing Council to cut the deposit rate even further. Right now, the deposit rate sits at minus 50 basis points, which means that it's 0.5% below zero. And market participants were expecting that to go down somewhere to about 60 basis points below zero, or minus 60, or perhaps even further. What the ECB did instead was offer a whole range of things that were wrapped around the deposit rate, but not necessarily, lowering the deposit rate. What the ECB did was offer a new round of targeted long-term refinancing operations that banks can take up. This is liquidity that they'll get borrowing from the European Central Bank, and they're going to borrow it at 25 basis points or 0.25% below the average in the main refinancing rate, which right now is zero. So basically, they're borrowing money at negative 25 basis points. And if they use the money to extend credit to the non-financial sector, then the interest rate that is attached to the loan from the European Central Bank can fall almost all the way down to, or actually all the way down to 25 basis points below the deposit rate. So in other words, it falls to negative 75 basis points. And in fairness, Christine Lagarde made that point clearly in both the opening statement and later on down. She also introduced the other measures that they had. There's an asset purchasing program is going to be augmented by additional purchasing power in the amount of 120 billion euros. There's going to be a change in the terms of the existing long-term refinancing operations to make them more generous as well. And so that's going to add even more credit into the mix. And crucially, all of this is being coordinated both with a shift in the collateral framework to make it easier for banks to borrow money, a shift in the collateral framework that made it easier for banks to borrow money, and and a greater regulatory forbearance that makes it possible for the banking supervisors to look the other way when banks forgive their clients, those people who've borrowed money from the banks themselves, for not paying back in a timely manner during this period of crisis, right? What Lagarde said on top of all that was in response to a question about what is the ECB going to do if the spread between Italian long-term government bonds widens out significantly against the spread or against German long-term government bonds. So if the yield on long-term government bonds in Italy widens out against the yield on long-term government bonds in Germany, what would the ECB do to stop that, right? Now, you'll notice that I've been presenting this with all the jargon, standard jargon and gobbledygook that normally surrounds these kinds of communications. And you'll probably also notice that there are many things that you didn't understand clearly about what I said. And that was intentional on my part. I want you to pay attention to that because I'm not convinced that Christine Lagarde understood all the things that she was saying either. Why? Well, because when she talked about the augmentation of the long-term or large-scale asset purchasing program, this $128 billion, she was pressed repeatedly. She was pressed repeatedly by journalists about whether the ECB was going to purchase these assets off the capital key. In other words, disproportionately, specifically whether they might favor one government's long-term sovereign debt over another, depending on what the market direction in the ECB, who, by the way, is Fabio Panetta, were to say is the important thing to be doing. And each time she got that question, she said, look, we're going to use all the flexibility we have at our disposal. We've got 120 billion euros. We're going to spend them as and when we need them. We're going to buy as and what we need to buy. And it's only over the long term that we're going to worry about getting back to the kind of proportionality that is our own form of self-restraint, right? She said that explicitly, not one time, but multiple times. And she also said we're going to ignore other forms of constraint, like issuer limits or issue limits. The ECB is not supposed to be overly exposed either to specific issuers of sovereign debt or to specific issues, specific instruments themselves. And there are good reasons for that. But as she was pressed on that, she said, no. Remember, we're going to use all the flexibility we have, right? And this notion of flexibility is critical. Because what it means is that if Italian sovereign debt starts to lose value dramatically relative to other countries, in other words, if the spread widens out between Italy and Germany, for example, the ECB has all the flexibility it needs to buy Italian sovereign debt to bring that spread right back down. It also has an interest in doing so, because if the spread widens and Italian sovereign debt becomes much less valuable relative to German sovereign debt, then that weakens the ability of Italian banks to get access to central bank credit because they use Italian sovereign debt as collateral to get access to credit, right? And the collateral would be worth less, which means they would get less access to credit, or credit would be relatively more expensive. And it also means that anytime they try to change interest rates, and remember, they're not changing interest rates this time at all. Anytime they try to change interest rates, then changing these interest rates will not have the same effect in Italy as it does in Germany. In other words, the monetary transmission mechanism that transmits a policy decision to change interest rates into real economic activity in different parts of the euro area, that monetary transmission mechanism would be impaired. And so when Lagarde was asked about the spreads, what she should have said is not what she actually did say. What she did say is, we're not here to close spreads. This is not the function or the mission of the ECB. And in doing so, in saying that, she contradicted everything she had said before that about the use of flexibility, about the the ease with which they would enter into the markets to stabilize the markets, and even the reason for which they would stabilize these markets. She contradicted all of that. And everyone who's used to listening to these press conferences knew that immediately. Twitter blew up with people basically pointing out, if it's not the ECB's responsibility to close the spreads, then whose responsibility is it? Lagarde says there are other tools for that, and there are other actors to actually deal with those issues. In fact, that's not the case. The only actor who can solve that particular problem is the ECB. Okay, what should Lagarde have said? Well, remember when I told you that everybody was looking for a rate cut, and that's because journalists are addicted to the idea that interest rates going down is a stimulus for the economy. And they were looking for a rate cut in the deposit rate in particular because that seems to be the only rate that can move right now. The main refinancing rate is at the zero lower bound. The marginal lending facility, which is the sort of punitive rate, is 25 basis points above that. You can't put the marginal lending facility on top of the main refinancing rate. There has to be a corridor between those two. And so the only thing you can do is just keep pushing down the deposit rate. But the deposit rate is negative, and it's a deposit rate. So what Lagarde should have said is, wait a minute, the deposit rate is a tax. We don't want to increase taxes on banks right now. This would be a controversial thing for her to say because the ECB doesn't like to admit that a negative deposit rate is a tax. They call it an incentive for banks not to stockpile surplus liquidity in the ECB on deposit, right? But let's face it, a negative deposit rate is a tax. The more money you have on deposit at the ECB above certain thresholds, and we can go into those thresholds in our discussion group if you're interested, but the more money you have in the ECB above certain thresholds, the more you pay in tax. And adding to that tax is only going to hurt the bottom line for banks. It's not going to make credit cheaper. But the ECB is making credit cheaper even without changing the deposit rate. How? By offering to subsidize the lending of private banks to non-financial corporations. How does it provide the subsidy? Well, what it does is it says, look, we will subsidize by giving you a discount on the main refinancing rate. So in other words, you could borrow from us normally at one rate, but we're going to give you a lower rate to borrow from us. Well, it happens that the one rate that you could borrow, the main refinancing rate, is zero. So the lower rate is minus 25 basis points. That's a subsidy for banks. They borrow money and the ECB pays them more money than they borrow. More important, by using the deposit rate as a benchmark, they're able to extend the subsidy. So what Lagarde should have said, and what she tried to say but didn't get across effectively, is that the ECB is providing generous subsidies to maintain credit. Unbelievably generous subsidies. It's paying banks to lend. It's not only paying banks to lend, but it's paying banks to lend against ever lower quality collateral and with ever lighter touch regulatory oversight. And that was a third point you should have made. We're working hand in glove with financial market regulators to make sure not only that banks have credit to lend, but they have a regulatory environment within which it's in their interest to keep that credit in place. And finally, she should have said, we have given ourselves this $120 billion in additional funds to stabilize asset markets. And when they asked her about this spread, she should have said precisely those spreads are the indicators that we use in order to identify when asset market prices are moving in ways that would impair the monetary transmission mechanism and create financial market instability. Now, how do I know this is what she should have said or meant to say? First, I read through and I watched the press conference, but I also read through the transcript, and she tries to hit these points in a convincing way, but she's using a language that's almost impenetrable. And worse, it's contradicted by that one bad thing that she said. There are some other areas where she contradicted herself as well, but that's less important than the fact that this one big contradiction wiped out a huge amount of credibility. She went back to CNBC and tried to restate the case, and indeed the official transcript of the press conference includes a footnote, and you'll see the footnote in that previous slide that I showed you. It includes a footnote that refers to the clarification she did with CNBC. Then the ECB actually created a whole new blog site where they got Philip Lane to come out and write the original blog post that explained what she should have said in his very complicated economic speak. And then Lagarde herself wrote a blog post that laid out in her own language what she meant to say. And what she says is that in fact, we're going to make sure that there is no impairment to the monetary transmission mechanism, and we're going to do whatever it takes, whatever is necessary to achieve that objective. And that language is repeated by Panetta, and it's also repeated by Schnabel. And in doing so, what we have is just a very strong chorus coming out. But the chorus by itself is not sufficient. The ECB actually had to put up additional money, creating a pandemic emergency purchasing program armed with 750 billion euros to spend during the course of the rest of this year, or so long as the crisis remains in place, again pushing back against any widening of the spreads. Well, why this extraordinary effort at clarification? Well, the answer lies in the market response. Now, what I've done on the left-hand side of your screen is put the response that took place on Monday and Tuesday of last week, and it was a truly terrifying moment, I have to say, watching this unfold. So I put the response that took place on Monday and Tuesday of last week, but then I put the whole month of coronavirus-induced spread on the right-hand side. Now, what you see on the left-hand side is that we went into the markets. We went into the markets on Tuesday, the 18th of March, and the markets were already jittery. On Monday, the spreads had widened out, which meant that the price of Italian bonds had fallen relative to the price of German bonds, and that had already widened out. But on Tuesday morning, as soon as trading started, people really began to get afraid. And you see the spread widening out from about 280 basis points to just under 330, right? Now that's huge. Italy hasn't experienced spreads like that in a couple of years now. And the presence of that kind of a spread in the context of this coronavirus crisis suggests that bond market participants are really unhappy with the idea of holding Italian sovereign debt. But then something really interesting happens after about 11 o'clock in the morning. So what I've showed you is what's going on up until about 11 o'clock in the morning. After about 11 o'clock in the morning, then it starts to dip down again. There's a little bit of a recovery, but then they start to fall quite dramatically in the course of the day. And then the next morning, the markets open up and the spread is down below 200 basis points. In other words, 1.3 percentage points, 130 basis points gets wiped away. And the explanation is that on Monday and on Tuesday, the ECB had actually begun to intervene, working through the Bank of Italy to buy Italian sovereign debt when everybody else was trying to sell it. They intervened as much as they could, but they realized that this intervention was not gaining the kind of traction that it needed. There was some discussion on Monday within the Eurogroup about whether they should create a mutualized sovereign debt borrowing instrument They decided not to do that. There was some discussion on Tuesday about whether the European Stability Mechanism should open up its credit lines without conditionality. That was not agreed to either. But then the ECB swung into action, and as soon as they announced this new pandemic emergency purchasing program, then the market said, okay, the big guns are out. There's no reason to bet against the ECB, and they all began to pile back into Italian sovereign debt, which is why the spread closes so dramatically. So far, so good. The ECB made a mistake. Christine Lagarde has actually apologized to the other members of the governing council for the error that she made in communication. They've fixed the communication error. They've introduced a new policy. Shouldn't we be reassured at that point? Well, I think we should still be a little bit worried. I think we should be worried for three reasons. First, what became clear throughout this is that Germany and the Netherlands are not really supportive of this policy. She was able to override Jens Weidmann, the president of the Bundesbank, and Klaus Knot, the president of the Dutch central bank, in order to push this policy forward. She even had to slap down Holzmann, who's the president of the Austrian, or the governor of the Austrian central bank, and who came out and said essentially that the ECB's arsenal is spent. So that aspect was problematic. And yet these guys are not going to go away. She's going to have to keep keeping them in the box. And if you were to look at the structure of the program that they've announced, she has to reiterate the importance of the key. She has to talk about, and so a lot of the flexibility that she had alluded to seems to be still there. And yet there's this hint of constraint that surrounds it. And that hint of constraint is also in the volume, right? I mean, when Mario Draghi came out in the summer of 2012 and calmed the markets in the height of Europe's sovereign debt crisis, he did so by arguing that the ECB would enter into the markets and make unlimited purchases. Now, it's obvious they're not going to make infinite purchases, so unlimited does not mean infinite because the supply of bonds is finite, right? And in fact, if you look closely at the way the outright monetary transactions are structured, they don't even attach themselves to all parts of the maturity spectrum, right? It's only residual maturity, less than 3 years. So that's a limited segment of the sovereign debt market. But unlimited means we're not telling you what the limit is in advance. And this, no matter how generous this policy is, this new purchasing program is limited, right? I mean, it's limited by the 120 that they originally put up. It's limited by the 20,000 that they're buying on every month in any event. And it's limited by the 750 that they've added into the kitty. And you have to ask yourself, given that we know Germany and the Netherlands are not really supportive of this idea, if they start to run out of money, are they going to get more? And the more bond market participants start to ask questions like that, the more likely they are to move against the Italian sovereign debt market. So I think that's a reason for concern. An even bigger reason for concern is we still don't know how bad this coronavirus is going to affect economic performance across the euro area. And that means also government finances and financial stability. And it could be the biggest disaster we've ever faced as advanced industrial economies. We just don't know. And since we don't know, and we have limited resources with which to respond, and we know that there's strong opposition to the resources that we have already, I think that's cause to be concerned. I think we need more reassurance. And the best way to get more reassurance would be through some debt mutualization, which would take place in the form of euro bonds, which is why that's highlighted there. We could also do the same thing de facto by getting unencumbered credit lines made available from the European Stability Mechanism, which is what Giuseppe Conte, the Prime Minister of Italy, has asked for. But we need more than what the ECB has currently put on the table. So we've almost had a financial crisis that was triggered by a mistake in communications. They've been able to walk that back. They've laid on some really good policies that have put the genie back in the box for now. But I think this is not something we can afford to take our eyes off. And so what I want you guys to do is watch this space.